Hello friends, welcome to the May edition of Monthly Viewpoints. Indian equity markets underperformed relative to the other global markets in April. However, one-year returns continue to be relatively strong at more than 50%. In April, mid and small caps outperformed large caps by a significant margin, and sectorally, metals and healthcare index outperformed. Now, to everyone's surprise, although concerns about rising COVID cases are impacting sentiment, equity markets are holding up fairly well. A point to note is that active cases are projected to peak out in India in the next few weeks, and herd immunity is expected by the end of this calendar year. A precedent from other countries like Israel is that once a country crosses 40% vaccination for its population, it has led to a sharp fall in new cases, and India is expected to reach that threshold by September this year. Also, in other countries like the US and UK, where even when cases surged by 5 or 6 times during the second and third waves and the imposed lockdowns, equity markets not only showed resilience, but also went up and are at their all-time highs now. Even amidst this equity rally, we are seeing that there is a quick sector rotation, with investors moving into global cyclicals such as metals and IT, and some defensive sectors like pharma and FMCG. On the COVID front, globally the situation seems to be stabilizing, although India remains an exception. There is clear evidence of higher mobility in countries such as the US, Israel and UK, where vaccinations have progressed quite well. In India, Maharashtra seems to have flattened the curve, and other states are expected to peak out in the next few weeks. The global economy continues to show broad-based recovery. PMIs are strong, led by the US and developed markets. In the US especially, stimulus checks are aiding a strong demand recovery. Strong global trade momentum is also supporting a recovery in emerging markets. However, in India, while some indicators like GST collections, rail freight, electricity consumption are still strong, various mobility indicators show that the Indian economic recovery will be impacted in the April to June quarter due to the second COVID wave. The focus is now on corporate earnings. Q4 FY21 results season is largely in line so far, with 1/3 of the Nifty constituents having declared results. In terms of sectors, export-oriented sectors such as IT and auto, investment-oriented such as cement and metals, and consumption-oriented such as staples have been resilient, whereas discretionary consumption has been lagging. The health crisis, fortunately, has not spilled over into a widespread financial crisis, as indicated by the absence of any large NPAs shocks in the financial system. Cost pressures are rising across the board due to higher commodity prices, but the ability to mitigate this by cost rationalization, product mix changes, and by passing on the cost to consumers is visible. The key monitorable now is the impact on the FY22 estimated corporate earnings. We are seeing a spread of COVID to Tier 2 and Tier 3 cities and to rural areas, which will impact sentiment and demand. However, expectation of a strong monsoon season should offset that to some extent. Retailers are indicating that footfalls are weak and auto sales will also be under pressure. At the same time, we have seen that the RBI has relaxed restructuring norms and announced a new window for fresh restructuring. So far, we have not seen any earnings downgrades for FY22 earnings, as it's still too early to assess the impact on the ground. However, we are likely to see significant downgrades going forward, as localized restrictions due to the rising COVID cases impact demand, and higher commodity prices will have a short-term impact on margins. Earnings estimates for sectors such as consumer discretionary, retail, auto, and oil and gas could be impacted due to lower consumer demand and lower mobility, and even other sectors such as real estate, infra, cap goods, and cement could be at risk of higher downgrades if there is a prolonged impact of COVID. On the valuation front, headline valuation multiples seem rich but can remain elevated versus the long-term averages, given the environment of low interest rates and high liquidity, which is driving strong FPI inflows. Coming to our view on the markets, we maintain a cautious view in the short term. Any correction should be temporary and minor. However, the short-term upside will also be limited, and markets are likely to remain range-bound. For the medium to long term, we maintain our view to play the domestic cyclicals and financials, as the economy should normalize by FY23. Investors should bear in mind that equity markets are always forward-looking. We offer a bouquet of products for investors to choose from. Thank you and happy investing.